Hello! Today's video would be all about 3 growth stocks that are unjustly falling in recent times. Growth stocks are companies whose revenue and earnings grow at a faster than average rate in comparison to other businesses in their industry or the market in general. The returns from the growth don't only benefit the companies but the shareholders as well, and these returns get bigger the faster the companies grow. While growth stocks have a lot of potential, there's a reason it is theoretically believed that having growth stocks at the end of an economic cycle is bad news to be avoided at all costs. Not to worry, we've got you covered. Make sure you watch till the end of this video to learn about these 3 stocks we expect blistering growth from, but are presently unjustly falling. Investing comes with its fair share of risks. With the dark clouds hanging over the financial market in recent times, especially as the result of the pandemic, stocks have been rather turbulent and unpredictable. This is reflected in the prices, and we can note few bargains on the market. 3 cyber stocks in particular seem to be having the worst share of the deal for no real fault of theirs, and it simply isn't fair. What are these stocks, you ask? Let's get to know them. Number 1. Ping. Ping Identity develops identity security and specializes in identity verification for entrepreneurs and global enterprises. Awarded the Cybersecurity Excellence Award in 2018, this leading customer identity and access management company is definitely a promising opportunity for investors. Headquartered in Denver, Colorado, Ping Identity also has offices across the world, including San Francisco, Austin, Boston, Vancouver, London, Tel Aviv, Melbourne, and more. In general, cybersecurity industry has plenty of potential, considering how fundamental cybersecurity has been in our tech-savvy age. Hackers continue to pose a major threat to businesses, and so no matter the current state of the economy or stock market, the cybersecurity industry continues to be in demand. This is great news to Ping, which offers a cloud platform built on artificial intelligence and designed to efficiently identify and respond to threats. Its function of restricting and authorizing users' access to critical business data is especially useful for system administrators. After the first quarter of 2020, Ping has seen year-over-year revenue growth of 44%. At present, we are looking at less than 8 times this year's expected revenue. Ping utilizes a subscription model for its stock, and to take the safe route, some customers chose short-term extensions during the pandemic. This resulted in skewed numbers, but we are certain that sales growth should increase in some time. Number 2. Wix. No business can underestimate the value of a website and its online presence. That's where Wix comes to play. Founded in 2006, Wix is an Israeli software company that offers cloud-based web development services to users. Using online drag-and-drop tools, the Website Builder tool allows users to build their own HTML5 websites and mobile sites. The company is built on a freemium business model, so its revenues are earned through premium upgrades. Wix's share price dramatically fell by more than 30% after the update on the second quarter from the end of July. So far this year, it has gone down by 28%. In spite of this, Wix reports increased year-over-year sales by 34% to $316 billion. This exceeds what was expected just a few months ago by $2 million. To have properly appreciated the company's impressive sales results, we could compare this to the 31% revenue rise to $198 million, which its competitor Squarespace had. This seemingly confusing report is reportedly as a result of the Delta variant presently spreading globally, which has created a lot of uncertainty and has led to the company's management to lower its 2021 forecast by no less than $25 million to $1.26 to $1.27 billion. Due to ongoing investments to drive long-term growth, management also reduced project free cash flow for the full year to a range of $35 million to $40 million from $62 million to $72 million. As always, there is a silver lining. Concern about another wave of the pandemic has provided a window of opportunity for investors to purchase growth stock. Being an industry leader in no-code web development, Wix is certainly one of such to invest in, with the company's impressive outlook and a stock trading at 113 times free cash flow. We are also looking forward to plenty of new features on the platform, which is sure to attract plenty of new users. Number 3. Pinterest. Functioning as a digital bulletin board or scrapbook for users, Pinterest is a visual discovery engine for finding ideas and collecting and sharing the things you find online. Users, or pinners as they are referred to on Pinterest, pin photos into collections called boards, which serve as big catalogs of objects. In the second quarter of 2021, Pinterest reported a 5% decline in the number of active users, which is possibly the worst thing that can happen for a web-based business model like Pinterest's. The global total increased 9% from last year to $454 million. The resulting effect is a fall in share price by as much as 20%. This is unfair for two reasons. First, the company's management considers most of the MAU declines to be due to the loss of less engaged and less profitable desktop computer users. There were increased number of younger mobile users even in the US during the second quarter, and that number rose further by 20% year on year. Second, Pinterest has proven its usefulness as a shopping tool. From the first to the second quarter of 2021 alone, there was a rise in the number of merchant catalogs uploaded by 50%. As a result of the company's integration with e-commerce software giant Shopify. Pinterest reports that its revenues doubled. As a result of this additional monetization of the user base, the average revenue per user, or ARPU, increased by 89% year over year. The second quarter revenues more than doubled from last year to $613 million. We're also looking at a 40% increase in revenues in the third quarter. Combined with the company's increased net profit, the stock trades at 96 times free cash flow, which makes investing in it a potentially highly profitable decision. Those are the top 3 unjustly falling growth stocks. What are your thoughts? Like this video and leave us a comment below. Feel free to also join the money-making community by subscribing to this channel. Don't miss out. Stay up to date with valuable information by turning your post notifications on. Thanks for watching our video. We already have a ton of helpful videos on our channel that you can check out, and we do hope to see you in our next one. Bye for now.